that we've sold. And that brings us to our traditional collar that we're going to be looking at. So a collar strategy is a strategy that limits both your downside risk and your upside profit potential. It is created by already owning stock and buying that protected put and selling that covered call. So a collar, like just about every strategy that you're looking at, is actually a study of risk and reward. So whatever you're looking at, whatever you've decided, keep that in mind, because every position that you put on, there's always going to be a nuance that is different from the last time. And so I'd like to think of this as being, part of our education, and we get to study what that risk and reward is. So in this case, our risk and reward is how do we limit both our downside risk and at the same time manage that upside potential. So the collar position, typically we're buying an out of the money put and selling an out of the money call. Now, if we just strictly look at our stock position, right? No options are on it yet. It's just a stock position. We're looking at our stock position. That stock can go up in value to infinity beyond, right? But it can go down in value. And a lot of times that is what we want to protect. And as we know, when we're buying any kind of protection, there's a cost to that protection. And to eliminate or diminish the amount that we pay, there is a lovely strategy called the covered call that brings in income, generates a premium that can offset the price of that protection. So through doing a collar, right, we basically are collaring off both our risk on the downside and our potential profits on the upside. So buying that put neutralizes your downside risk. And by buying that call, we're basically looking at maxing out our profits to maintain that downside protection. So essentially, as an investor, you are trying to construct a position that fits your narrative on what you think that potential risk could be, right? Stock selection is key to that risk. So if you are selecting an at the money put because you don't want any downside risk, you're going to pay more for it. So when you're looking at how you're going to mitigate that price, you're going to now select a strike, a call strike.